Why your QuickBooks looks fine, but your accountant is panicking. Your year-end reality check. My books look fine. I don't know what you're talking about. That's what Mike told his accountant in December. By February, he owed an extra $3,200 in taxes and $800 in accounting fees to fix what looked fine. If you think your QuickBooks is in good shape, this video might save you thousands. Here's what most business owners don't realize. Your QuickBooks can look absolutely perfect to you and be a complete disaster to anyone who actually knows what they're looking at. I'm talking about books that balance, have no red numbers, show consistent profits, and still cost their owners thousands of dollars in unnecessary taxes and fees. Mike's story isn't unique, in fact. I see this exact scenario every single tax season. Business owners who are confident their books are in great shape, only to discover they've been making expensive mistakes for months or even years. Hi, I'm Bev from bookkeepingcoach.net. And I got this email from Mike after his tax appointment. You were right. My accountant said my books were a disaster, but they look perfectly fine to me. Everything balanced, no red numbers. All my transactions were categorized. How was I supposed to know? Great question, Mike. The answer is QuickBooks is designed to look pretty, not to be accurate. It's designed to make you feel good about your bookkeeping, not to actually keep you out of any trouble. Let me tell you about Mike's business so you can see if you recognize yourself. Mike runs a home improvement company. He's been in business for 4 years, has 2 employees, and typically makes about $300,000 in revenue annually. He's tech savvy, organized, and takes pride in staying on top of his paperwork. Every week, Mike would log into QuickBooks, connect his bank feed, categorize his transactions, and review his reports. His dashboard showed steady profits. His bank accounts were reconciled, or so he thought, and everything had a category. From his perspective, his books were in excellent shape. But here's what Mike didn't know. Looking good and being accurate are 2 completely different things. His QuickBooks was like a beautiful house built on a foundation of sand. Let me paint you a picture of what Mike saw every time he logged into QuickBooks. His dashboard showed a nice green profit for the year. His bank accounts showed the correct balances. His expenses were neatly categorized into logical accounts like office supplies, vehicle expenses, and equipment. Everything looked professional and organized. But here's what you can't see from that pretty dashboard, and what Mike's accountant spotted immediately. First, unreconciled transactions, going back 6 months. Mike thought reconciliation meant that his QuickBooks balance matched his bank balance. He didn't understand that reconciliation means comparing every single transaction in QuickBooks to every single transaction on his bank account and making sure they match perfectly. Second, the same transaction recorded 3 different ways. Mike had automatic bank feeds bringing in transactions, but he was also manually entering some of those same transactions. Plus, some of his recurring bills were being recorded automatically and manually. His income was overstated nearly $15,000 because of duplicates. Third, income reported in the wrong year. Mike received a large payment in December, but the bank didn't process it until January 2nd. QuickBooks recorded it in January, but for tax purposes, it should have been in December because that's when he received it. This mistake shifted $8,000 of income to the wrong tax year on an accrual tax basis. He had assets categorized as expenses. Mike bought a new truck for $45,000 and recorded it as vehicle expense. This made his expenses look $45,000 higher than they actually were and completely messed up his profit margins. Assets and expenses are handled very differently for tax purposes. Missing transactions that he didn't even know were missing is the 5th item. Cash payments from customers, small expenses paid with petty cash, PayPal transactions from online sales, none of it was in QuickBooks. His revenue was understated by $12,000 and his expenses understated by $3,000. The 5 hidden problems. First, unreconciled accounts. Let me explain what reconciliation actually means, because this is where most people go wrong. Reconciliation isn't just making sure your QuickBooks balance matches your bank balance. It's about making sure every single transaction in your QuickBooks appears on your bank statement, and every transaction on your bank statement appears in QuickBooks. Mike had transactions from July that were never properly reconciled. His current bank balance in QuickBooks was actually from 3 months ago. But because the overall balance happened to match through a series of coincidences and errors, he thought everything was fine. When your accounts aren't properly reconciled, you have no idea if your financial reports are accurate or not. You could be missing income, missing expenses, or both. You could have duplicate transactions that make your profits look higher or lower than they actually are. Here's the other kicker. A lot of people don't realize that you also need to reconcile all your credit cards, any liability accounts, which includes loans or lines of credit that you may have. Next, duplicate transactions are incredibly common, and they happen in ways most people don't expect. Here's how it worked with Mike. He had automatic bank feeds set up, which is great, but he also liked to manually enter transactions when he knew they were coming to keep his cash flow projections accurate. So when he invoiced a customer for $5,000, he'd manually enter the expected payment in QuickBooks. Then when the payment actually came through his bank account, the bank feed would bring it in as a new transaction. If he wasn't careful, and he wasn't, he'd end up with the same $5,000 payment recorded twice. Mike thought he made $2,000 more per month than he actually did because of these duplicates. He was making business decisions based off inflated income numbers. He hired an additional employee thinking he could afford it, but the extra income he thought he had didn't actually exist. Wrong categorizations is the third problem. Remember that $45,000 truck Mike bought? He coded it as vehicle expenses because, well, it was a vehicle and it was an expense, right? Wrong. In accounting, there's a big difference between an asset and an expense. An expense is something you use up in the current year, like gas, office supplies, monthly insurance payments. An asset is something that will benefit your business for multiple years, like equipment, vehicles, or buildings. Assets get depreciated over time. Expenses get deducted immediately. By recording the truck as an expense, Mike's profit looked $45,000 lower than it actually was. This affected his ability to get business loans, and it meant his tax preparer had to completely redo his depreciation schedules. More importantly, it meant Mike had no idea what his actual profit margins were on his jobs. Problem number 4. Mike's business involved a lot of small cash transactions. Customers paying cash for small jobs, buying materials with cash, paying subcontractors in cash for small tasks. None of this was making it into QuickBooks. Over the course of a year, Mike collected $12,000 in cash payments that never got recorded. This meant his revenue was understated, his profit margins looked worse than they were, and he was missing out on legitimate business deductions for the cash expenses he paid. Problem number 5 is timing issues. This is where things get really technical, but stay with me because it's important. Mike was mixing cash and accrual accounting without even realizing it. Sometimes he'd record the income when he sent the invoice, sometimes when he received the payment. Sometimes he'd record expenses when he ordered something, and sometimes when he paid for it. This created a nightmare at year end. Expenses were recorded in January, income was pushed to December, his year-end numbers were completely wrong, which meant his tax planning was also wrong, and his quarterly estimated payments were wrong. The cost breakdown. Here's what Mike's fine-looking books actually cost him, And I want you to understand that these aren't theoretical costs. This is money that came directly out of his bank account. The immediate costs, $800 in extra accounting fees to fix everything. Mike's accountant had to essentially rebuild his books for the year. $3,200 in additional taxes because his deductions were wrong and his income was reported incorrectly. $450 in IRS penalties because his quarterly payments were based on inaccurate numbers. Time costs, 24 hours of Mike's time, gathering missing documentation, trying to remember what cash transactions were for, and explaining to his accountant what each questionable transaction was supposed to be. At $175 an hour, which is reasonable for a skilled contractor, that's a ton more of his time. There are also hidden costs. This is where it gets really expensive. Mike made business decisions all year based on wrong financial information. He thought he was more profitable than he was, so he expanded too quickly. He thought he had more cash than he did, so he took on jobs that required upfront material costs he couldn't actually afford. The business decisions made on bad financial data cost him an estimated $8,000 in lost opportunities and cash flow problems. He had to turn down jobs because he didn't have the cash flow he thought he had. He had to delay paying suppliers, which damaged some important relationships. And then there's the stress and missed opportunities. Mike spent March and April of the following year dealing with tax issues instead of focusing on his busy spring season. He estimated he lost about $5,000 in potential income because he was so distracted by cleaning up his books instead of bidding on new jobs. Here's the proper QuickBooks maintenance actually looks like. And this is a system I teach to all of my clients. Weekly, and this takes about 10 minutes, not hours, check the bank feeds for new transactions. Don't just approve everything automatically. Actually look at each transaction and ask yourself, is this categorized correctly? Is this a duplicate of something I already entered? Is this a business expense or a personal expense that needs to be reclassified? Monthly, spend at least 30 minutes reconciling all your bank accounts, credit cards, and liability accounts. And I mean really reconcile them, not just check the balances match. Go through every transaction on your bank statement and make sure it appears correctly in QuickBooks. Run a quick profit and loss report and ask yourself, does this make sense? Do any of the numbers look too high or too low? Quarterly, review all your expense categories for proper categorization. Look for accounts that seem too high or too low. Check your asset accounts and make sure equipment purchases aren't mixed in with regular expenses. Run comparison reports to spot trends and anomalies. But here's the real key. Change your mindset about what done means. Having all your transaction categorized isn't done. Having your balances match your bank account isn't done. Done means having accurate, reliable financial information that you can use to make smart business decisions. Look, I'm not trying to scare you, but Mike's story happens every single tax season.